Good morning, and thank you very much for joining us this morning. My name is Akona Mlamlili, Portfolio Manager at 274 Investment Managers. Thank you very much for joining us at our 274 Academy session, in which today we'll focus on pension funds and private markets in particular. This morning, my colleague Rory Ord will lead the presentation on how pension funds should include private market investments in their portfolio strategy. Just before we proceed, some key house rules that I'd like to bring to your attention. We have approximately 10 to 15 minutes of questions and answers after Rory's presentation. We request that you please submit any questions in the Q&A panel during the course of the session. And after the presentation, I will pose these questions on to Rory. So without any further delays, I hand over to Rory Ord, who is the head of Unlisted Investments here at 274 Investment Managers. Rory, on to you.
Thanks very much, Makona, and welcome to everyone who's joining us this morning. I think these difficult times that we're living in are one that gives an opportunity for a lot of reflection, and I think probably one of the most common reflections that we've heard is that these times are actually accelerating a lot of the trends that were in place before in our pre-COVID lives, if we can remember back that far. So one of those trends was actually the emergence of private markets for pension funds in South Africa, and something that's been growing over the past few years. But we've seen over the past little while a real acceleration in the conversation, an acceleration in the questions that we're getting in this area. So we thought it was a good time to open up the session to have a 274 Academy session on how South African pension funds can be considering private markets as part of their broader investment decisions. So we've got a mixed audience today of everyone from people representing pension funds to different asset managers, some consultants. So hopefully there's a little something for everyone in the presentation. And like Akona said, we will have a question and answer time at the end. So if you do have questions, please just post them in the chat, and then Akona can let me know which ones I need to answer at the end. All right, so I think what often is interesting to people who haven't invested into private markets before in South Africa is just that they are a little bit less private than people think. You know, if you're someone living in South Africa, you've no doubt used many different products and services that are ultimately provided by companies that are backed by private equity funds, and these are just some examples of companies that are either currently or have in the past been owned by private equity firms. So, you know, whether you're providing food for your children, furniture for your house, clothes, you're ordering things online, whatever it might be, chances are that you're using private equity-backed firms in your everyday life. So it's not quite as obscure as sometimes people think. So, I mean, the kind of the common view, you know, when we bring up private markets, particularly with people who haven't invested in private markets before, you know, the common view is that it's either that private market investing is very early stage investing, or that it's some sort of caricatured, rapacious version of private equity that just seeks to fire people and strip assets from companies. But actually, I mean, almost everything that happens in the private markets in South Africa really sits in the space of either the mid-market or kind of the large private equity space just below the listed market. So that's where almost all of the activity is. There has been quite a nice trend over the last few years, you know, with the success of the 12J tax incentive to have more investment going into earlier stage investments, and that has been one of the successes of private markets in the last 2 years. But by far the majority of capital goes into either mid-market private equity or in the buyout side. So these are mostly companies, with turnover that's over 100 million or into the low billions. So they're well-established companies. I think that the big question for pension funds is, well, aren't private markets more difficult? Do I really need to bother with this? Is it something that I really need to focus my attention on and have a look in this area? And so there's a couple of good reasons why pension funds should actually consider it as part of their broader allocation decisions. So firstly, there's two main reasons. There's alpha generation opportunities, and then there's the opportunity to reduce volatility in portfolios. And so let's just unpack those two things a little bit. So first of all, on the side of the source of alpha, as you can imagine, there's an entirely different investment universe of companies that are out there that are available to private markets investments. These are not, these companies are not listed anywhere. These are just general companies that are operating in the markets in South Africa as a whole. So there's thousands and thousands of companies that are out there that sit within the private markets universe, as opposed to the listed universe, where there's quite a lot of focus on the same shares. So, for those who have investments into private equity funds, the chances of having overlap in portfolio companies is actually quite small between those private equity funds. So you have that diversification that comes from having a different universe, and a source of alpha that comes from that. Secondly, there's definitely some lower deal pricing that can happen in private equity. Not quite as bound by the market. There's much more negotiation that happens around deal pricing, and so you often see structured deal making, and there's definitely the opportunity for lower entry deal pricing in private equity, which is one of the ways that private equity firms actually generate some alpha. Then under reduced volatility, I think the cynical view of private equity is that it can reduce volatility in funds just because of a less frequent pricing that happens. There is an element of that. Private equity is not priced daily and every minute in the list as listed markets are. But at the same time, that means that they're not as subject to sentiment. There's a certain because companies in the private markets are not priced so often, and the view of investors is longer term, you don't get as much of the volatility and the spikes up and down in pricing that you do in listed markets. And it's not only because of when the pricing is actually done. The second point here is that when investments are done in private markets, they're not only done just in a standard share like they would be in a listed company. There's a lot of opportunity for deal structuring, so particularly downside structuring. So mostly what you see in private equity investments is that it's not just ordinary shares that are purchased. There's normally some structuring element that's done to protect the downside risk. So what private equity practitioners are actually trying to do is to create an asymmetric return. So they're trying to cushion their downside to protect that, and still have full access to the upside of their returns. So that makes it something that's slightly different to just buying a listed share as well, where there's kind of an equal bet either way in the way that the share price might perform. So that's the theory. What's actually happened over the recent past? Clearly the South African environment has been difficult for a long time, and there has not been a lot of performance to be gained from any asset classes for quite some time. But what we can say as well, while the JSE has been flat over the past 5 years, private equity has at least managed to eke out some performance. And so we've seen around a 6 to 7, depending which index you use, around 6 to 7% outperformance that's come from private equity industry over this period, which is encouraging. But the returns have been lower. As listed equity returns have been lower, private equity returns have also been lower. They're not immune to the market, but they've managed to significantly outperform listed markets over this period. Another very important reason to look at the private markets, and this is something that's come up a lot with our pension fund clients and other stakeholders over time, is the ability to create impact in private markets is much higher than it is within the listed market framework. And that's really because of the nature of private markets investing, that it's got a much more of a medium to long-term focus than other forms of investment. So it allows investors to actually plan the impact that's going to be made and structure investments in a way to create this impact. So when a deal is actually being done, plans can be put in place. Detailed plans can be made with the management of the companies or with the sponsors of the projects to work out exactly what's going to happen from a job creation point of view, a transformation point of view, how are the different ESG elements of the deal going to be tracked over time. And then what's also come up in more recent times is this focus on the sustainable development goals. And I'd say now most of what happens in the private markets has at least got some element of reference to the sustainable development goals and how the particular investee company or particular project is going to assist in the advancements of those goals. So really what private markets does is it allows a much more impactful way of investing than is possible to achieve in other asset classes. So when we're looking at when we're looking at what happens in any asset class, it's important to keep an eye on what's happening globally. And I've got a few slides now just on the global picture. So from a return point of view, private equity returns have been really very, very strong for a long period of time. They've averaged around 15% per annum globally. That's in dollar terms over a long period of time. As you can see from the charts, there has been some ups and downs. There've definitely been better times to invest and worse times to invest. But I think for investors that have consistently invested through these cycles, they've got a pretty good result from it, particularly in comparison to some asset class returns over the same period. So as a result of this strong performance, there have been a lot more allocations. So what this chart is showing is what are the largest pension markets in the world, how do they consider private markets, and how they're allocating to these to private markets and alternatives in general. So these markets are called the P7. These are the largest pension fund markets in the world. And between these seven, they actually make up around 90% of the retirement savings globally. The US alone is a very large component of total global retirement savings, but across these markets, they make up the bulk. South Africa, relative to its size, is actually quite a well-developed pension market and has quite a high level of savings compared to many other countries. But when we look at these countries, you can see, the allocations to alternatives tend to be quite high. Because of the weighting of the large markets such as the US, you actually see that on average, if you put all of these pools of pension savings together, you'd find that around a quarter of the total savings actually go to alternatives nowadays. Now it's a little bit difficult to tell exactly how much of that is in private equity versus infrastructure versus private credits and real estate and all these sub-asset classes. But it's interesting to see this large skew towards alternatives in general compared to what we're doing in South Africa, where there's a very, very low allocation to these. And we would say that, if South African retirement funds even contributed, the Reg 28 limit, we would have probably another 500 billion rands sitting in the private markets within the country. So these big allocations and these large flows have helped the development of the markets globally. And you can see from this chart that there's been a lot of segmentation that's happened as well. So there's been, the buyout category, which has done exceptionally well globally, is the largest category. But on top of that, there have been many other subcategories formed. Things like real estate. There's been a huge growth in the venture space, and then lots into subcategories like private credit, mezzanine, and even things like natural resources that have formed subclasses of private markets investing. South Africa is not quite as segmented as this yet, although we do have at least some private equity practitioners doing most of these smaller categories. So if there is interest, it is possible to find parties doing these subclasses of private markets investing. I'd say maybe the big difference in South Africa compared to the global situation is that that buyout has not really been favored at all by the market conditions over the past few years. Whereas globally there's been a very low interest rate environment, and there've been reasonable level of growth. In South Africa, we've had very low growth and quite high interest rates, which have made the buyout space quite difficult. But in the time while the buyout space has had a difficult time, there's been a lot more opportunity in other categories of private markets. So really I'm talking about the global situation. We've seen this trend and this growth of allocations towards the private markets. And so we think private markets are a big part of the future, even in South Africa, where the numbers are still small, but they definitely have been growing. And just to give some more of that global context, if we go back 20 years, the global allocations to alternatives were not that far off where they are in South Africa now. And there's just been a huge shift towards incorporating more of these alternative investments for some of the reasons we outlined earlier in the session today. And part of the reason for the growth in private markets has also been what's happening on the listed markets. So, that if you look at the number of shares listed on the JSE over a long period of time, it's been declining over the past few decades. It's, if you go back to 1990, we had around 700 listed companies. When you exclude things like cash shells and trusts and ETFs and all of that, you can see a clearer picture of what's happened in the number of listed companies on the JSE, which has come down to around the 300 level mark. And at the same time, you can see on the chart on the other axis that we're showing the growth of private equity assets during this time. So they have offset each other to some extent. But what's also been happening is some shift of assets offshore and some consolidation of listed companies as well. So I mean, in the fact that South African institutions haven't really yet made a big shift towards alternatives, and that the listed markets have been becoming more concentrated, the question comes up that can we really continue to focus so much of the investment energy that goes on in the country and the institutional market to such a small number of listed shares? And that shrinking in the number of listed companies and kind of some of the other dynamics that are going on in the listed space have meant that there's really around 60 shares that get almost all of the attention. Outside of those those shares, you start to get a drop off in liquidity, and it starts to become a bit more difficult for asset managers to really include them in portfolios in a meaningful way. So yeah, I think what this chart is trying to demonstrate is that, you know, in South Africa as a whole, we've got, you know, more than 1 million companies. And even at the size of 100 million turnover and up, we've got perhaps 10,000 companies that operate at that level. And we're spending a huge amount of focus just on that very peak of this pyramid. And I guess the point of looking at alternatives is to say, well, what opportunity lies outside of there? Are there not other types of companies that we can get exposure to that are going to help our overall portfolio dynamics? Of course, outside of that, outside of those considerations, there's also other types of direct exposures that are only possible through private markets. You know, I guess what this slide is alluding to is infrastructure, and what, you know, there's been a lot of talk around infrastructure lately with the government's focus on putting a large infrastructure program in place, and you know, whichever form that takes, and however that really happens in the end, there's going to be a large focus on private markets to make that happen. There's certainly a role for private markets practitioners in making sure that that program is a success. But outside of the infrastructure space, you know, also just simple things like access to more technology-focused companies, more growth companies, more mid-sized companies. There's a lot more, you know, that has to be achieved through the private markets. So there's reasons why a lot of investments happen through regulated products, through listed markets. It's much easier to invest through those channels in a lot of instances. And there are some common concerns or common sticking points, common criticisms that come up with private markets investing. You know, the same points come up all the time. So I'm just going to address the largest ones here, the most common sticking points that come up. And I'm sure we'll get some more on that in the question and answer session as well. So I think the trick with all of these things, these sticking points, the trick is to understand what they are, understand some of the different dynamics that happen in private markets that are not there in other asset classes, to understand these, and then see how, you know, your portfolios can still get access to the benefits of private markets while working within these different peculiarities that you get in the unlisted space. So the first one is always fees. The fact is that fees are definitely higher in the unlisted space, and there's good reason for that. That doesn't mean that it's a comfortable thing. That it doesn't mean that that retirement funds should be happy about paying higher fees. But this is just to say there are some reasons for it, and then I'll touch on a few of the mitigations around it. So first of all, you know, the reason why fees are higher is that these asset classes are very resource intensive. So this doesn't involve, you know, finding deals on a computer screen, doing research, and deciding which companies to back and call your broker and get the deal done. These things must be sourced. You know, the deals must be found. They must be negotiated. They take a lot of post-investment management to make them successful and to drive the kind of value add that results in strong returns. And then eventually they must be exited. So all of those elements of the deal cycle are reliant on having you know, highly qualified, highly experienced individuals to actually execute on them. And the managers must actually maintain this team throughout the fund life cycle. And in order to do that, it requires a level of fees that are higher than in the listed markets. It's also important to note that the private markets funds tend to be closed-ended vehicles. So they tend to have a finite fund size. And most of the time, they're actually restricted by their investors as well from raising more funds under certain circumstances. And in some times, the fund sizes are also capped. So what that does is it actually limits the income earning ability of the managers to a certain level. And then the managers must manage their resources and their salary bill and their office rental and all these kinds of things within that salary bill. Within that budget. So yeah, I guess there are some constraints that are unique here, and that's just something that investors need to get their heads around and understand and see, does it still make sense after the fees? So in mitigation, I mean, the returns that private equity practitioners are measured on at the end of the day is after fees. So we need to consider as investors into private equity funds and private markets funds more generally, we need to be considering what are we looking at as a net return after all of the costs and things involved. Are we still comfortable with the level of return that we're going to get out? And this is the same with considering performance fees. So managers of private equity funds typically do get a performance fee, a carry that comes, and this is determined after returns on all fees, on all management fees. So there's a waterfall of cash flows that happen to return cash to investors, and the investments of the funds must actually earn enough return both on their invested capital into those deals, but also on fees. The returns have to be earned on those fees and returned to investors before the actual performance fees start to come through. It's also important to note that where we've quoted industry performance and returns, both globally and locally, all of those returns quoted are net of fees. So they're all after the management fees and after performance fees and after all the costs of running funds. All of those returns are quoted net. So it is those numbers are comparable and understandable. The second point that's normally raised is around liquidity. So I just thought I would include a chart around what the liquidity of a private equity fund normally looks like. This will be familiar to anyone who has invested in private equity funds in the past. But the model of private markets is really mostly not putting all your capital in at once and then having it locked up for a long period of time. It's in almost all cases, it's done on a commitment and drawdown model where capital is committed on day one, and as the manager requires the capital to make investments, that gets drawn down over a period of time, over the first few years, which is called the investment period of the fund. And then after that period of time, the investments start to get realized and capital returned to investors. So although you might see that a fund has got a 10-year life, a private equity fund has got a 10-year life, you can actually kind of expect rand for rand, each rand to be outstanding for a shorter period than that, perhaps 5 to 7 years, that each rand would actually be outstanding before it comes back. But liquidity, nevertheless, is a very important aspect for pension funds and must be considered. So this is why we see relatively small percentages committed to private equity. In South Africa, I mean, it's very low, as we discussed earlier, and certainly more liquidity sacrifice can be made and handled by most funds. But each pension fund must consider its own liquidity needs. And the dynamics of its membership base, and whether it's contribution positive on a monthly basis or negative, looking at the age profile of the membership base, and all of these other considerations to work out what are the real liquidity needs of the fund, and work out whether it can make a liquidity sacrifice in order to get some of the alpha that can be generated in private markets. It's also useful to consider crisis situations. You know, we've just been through a crisis situation, and to say, well, what would happen? What would we do as a pension fund in a crisis situation? Where would our liquidity come from? How could we still meet our obligations during such a time? Do a bit of stress testing on the portfolio and see, you know, what is our real liquidity need, and where can we make a liquidity sacrifice in order to generate some alpha. I think it's also important to know that, you know, with the profile that I was just discussing here, where, you know, you put capital in over a period of time and it starts to return after a few years, as and when a broader portfolio gets constructed and made up and implemented over time, this becomes much more of a process of constantly allocating and constantly receiving capital back. It becomes much more of a manageable process. And that can also be factored into liquidity considerations. There is also, if the worst comes to worst, there is still a secondary market for private equity fund stakes. So it's not to say if a pension fund is committed into a private equity fund that it has no alternative but to stay in there. Globally, the secondary market for private equity fund stakes has been very strong, and there are many funds and many pools of capital just set up to actually purchase secondary stakes in private equity funds. And locally, there's a reasonable market for those stakes. So if pension funds are in funds that they don't want to be in any longer for whatever reason, in most instances they can actually, there is a source of liquidity there for them. So the third sticking point is often around, and this particularly applies to DC pension funds, is what about, you know, valuations and administration of the fund? How do I how do I think about those aspects? You know, is the pricing good enough in private equity? Are they going to be able to fit into my administration systems, etc.? So I think the good news here is that there's been enormous strides made over the past decade or so in this area. You'll see here on the slide, there's a picture of the International Private Equity and Venture Capital Valuation Guidelines. These guidelines are accepted around and applied around the world. They've been developed over various iterations over a long period of time. And yeah, over probably the last decade, there's been a massive improvement in the way that private market funds actually do their valuations. You know, they used to apply cost for far too long, which made things difficult for DC pension funds. Now basically the rule is that every time private equity funds report to their investors and report valuations to their investors, they must be considering the fair value, and they must be running a process to make sure that they're giving a good indication of fair value each time they report. So that means that it's taken away a lot of that uncertainty for DC funds on how, you know, whether they're actually getting accurate pricing or how stale that pricing is that they're getting. So there's a lot more control over the valuation process. Valuations are a lot more accurate. There's also, in a South African context, I'd say there's a lot more focus from investors that have come into this area, and so that means that private equity funds are being pushed to do more accurate valuations, and that's it just results in a better situation for all the stakeholders. There are also, you know, annual audits that get done. You can request monthly NAV statements, and most administrators now can accommodate private markets investments and know how to do it. Yeah, so if you can get comfortable as a pension fund with those major objections and those major sticking points, then the question is, well, how do I actually do this? What are the other considerations in order to invest in private markets responsibly as a South African pension fund? So firstly, we've got to consider regulation. So private equity investing, private markets investing is allowed under Regulation 28. There's a 10% limit currently, and up to 15% when combined with hedge funds. The industry body SAVCA has actually put forward a recommendation that for some changes in Reg 28 to allow a slightly higher allocation towards private markets, and also for it to be decoupled from the hedge fund category. And we wait to see movement in that area. When Regulation 28 was last changed back in 2011 to recognize private equity as a category for the first time, the regulators also released a supplement to Regulation 28 called the Conditions for Investment in Private Equity, where they set out a lot of the conditions on which South African pension funds can invest. So this is something that's specifically been contemplated by the regulators, and they've set out the way that pension funds should actually look at private markets investing. So they put a number of conditions in place. They've said that private equity managers must be Category 2 fiscally regulated. They must be members of a recognized industry body, such as SAVCA. They've said that the assets of private equity funds must be subject to 6 monthly scrip counts. And then on at least an annual basis, the valuations of the investments must be subject to external scrutiny. And then the funds are also subject to audit. So there's quite a number of controls that sit over private equity funds and are contemplated in the regulations. So this is something that regulators are clear that it has a place within the investment framework within the country, subject to these constraints. I think what is really important to know if you're a South African pension fund looking at private markets is to understand this dispersion in returns that happens, relative to other asset classes. As I was mentioning earlier, there, in the investment universe for private markets, there are thousands of companies, and if you, for example, compared private equity investing to listed equity investing tends to be a lot more benchmark cognizant, and there's a lot of overlap between what one manager invests in and another manager invests in. So what that leads to is a much tighter grouping of investment returns. In unlisted markets, you get a much higher dispersion of returns, and the best managers get much higher returns than the worst managers, and there's a much higher dispersion. So using the global data, which is just a bit more robust than our local data, in an average year, there's actually a 15% difference to what your average manager in the upper quartile is achieving compared to what's happening in the lower quartile, which is a huge difference. If you think about the compounding that takes over time, that's a really big impact. What's also clear in private markets is that there's a lot more repeatability. The best managers are much more consistent as the best managers within the private markets than is the case within public markets. So selection is extremely important. The other thing that's very important is to invest through the cycle, because it's not always clear exactly where you are in the cycle. It's important to have consistent exposures and to try to maintain the exposure. And with that cash flow profile that I was showing you earlier, with the constant investing and then receiving capital back, it's important for pension funds to be thinking about how they get that ongoing exposure, how they make sure that they're actually that they're exposed across the cycle. Because what we can see, and again, these are global returns, and these are global vintage year returns that have been achieved over time. What we can see that the best returns actually come in the wake of these big crises, if you like. So after the Asian crisis and then the dot-com crash in the late 90s to 2000s, there was really a high resurgence in returns. And similarly, after the global financial crisis, returns came through really strongly after that period. So I think ideally, you'd want all retirement funds to be able to put a full private markets program in place and think about all the options and be able to manage the whole process very nicely and get good exposures to the different subcomponents and all of that. But I think there are realities, particularly in South Africa, where we still have a lot of retirement funds. There obviously is some consolidation that's happening across the industry. But we still have, a handful of very large retirement funds and then a long tail of smaller funds. And the way that each of these funds can approach private markets does depend to some extent on their size. So for very large funds, put 30 billion as a marker there. But it could be a little bit smaller than that as well. It is possible to put in place a full program that is run through the retirement fund itself, because that allows fairly large allocations to happen over a long period of time, and to actually maintain that exposure, to do the reinvestment and the recommitment that's necessary to actually maintain a program. As you go down, some of the options are taken away, and smaller pension funds can either take the approach of opportunistically investing in the space. So when they particularly see something that's exciting, something that they think can get the diversification that they want, or there's a particular opportunity for alpha, they can take that. Or alternatively, if they want broader private markets exposure, then they can use the fund of funds route. And I think we're even seeing now that even very small pension funds can use that funds route for very small allocations, and can at least get some exposure to private markets. So I think in conclusion there, there is an option, there is a way for all sorts of different retirement funds to actually consider private markets within their broader allocations. So before we go on to the questions, just in summary of what we've talked about today. So we think private markets can offer a return premium. They've got different sources of return. It's also a way to achieve impact, and it's something that we're seeing a lot more retirement funds looking at. Globally, this is well established, and this has been a huge trend over a couple of decades now, and it's been very, very beneficial for retirement funds. I actually didn't include a chart, but I have a chart on showing how retirement funds that globally that have had private markets have performed versus those who haven't, and there's a significant outperformance with those who have, given those average 15% per annum dollar returns that have happened at the time. And lastly, there are practical routes. So almost any retirement fund can actually think about private markets, and if it sees the case, if it sees the benefits on the portfolio as a whole, there are routes for every retirement fund to actually include private markets in their portfolio. Right, that comes to the end of my presentation. If there are questions, Akona, we had some questions coming through.
Yes, thank you very much, Rory, for such a comprehensive presentation this morning. Before I move on to questions, I just want to let the participants know that the presentation that Rory has just done for us will be available to all participants within the next 4 hours. And also just to also indicate that also, please can you guys kindly provide us with the feedback after the presentation. So let's move on to the questions that have come across from the participants that have come through this morning. So one of the questions that have come through are, given the current COVID macro environment, are you seeing more opportunities, and what does the environment mean for current invested funds? If you can just tackle that, Rory.
Sure. Yeah, this is obviously a moving target at the moment. The macro environment is probably more uncertain than most environments that we've seen for a long period of time. I think that over the last few months, we've seen the debates about the shape of the recovery, locally and globally. I think what is a very beneficial thing to see is that interest rates have started to come down, and we're actually at levels that are the lowest that we've seen in decades, and that will certainly help the recovery environment. Look, I think the macro picture, we like more to talk about in private markets. We like to talk more about the micro, actually, because the macro is important, and it is the tide that can lift or drop all the boats. But it's actually much more important what's happening in individual sectors. So even through the COVID lockdown period, what's happened in one component of a sector might be entirely different to what's happened in another component of the sector. You think, for example, about logistics as an argument is a one that we talk about quite a lot. In some of the longer haul logistics, there's been really a lot of difficulty in moving some goods around, at least. Whereas in the delivery to home, there's been enormous demand for services and businesses that service that part of the market. So I think the whole of what private equity is about is more operating at the micro level, making sure that the particular parts of a segment that are approached are the ones that are going to give you those outsized returns. But a better macro environment would help all of us at the same time.
Okay. And then also in one of your slides, you obviously touched on how South Africa obviously has very much under allocated to PE and private market funds in South Africa. Can you maybe just tackle some of the historical reasons for some of this?
Yeah, so I think, first of all, Reg 28 was a big thing, so until 2011, there was no category for private equity. It was not recognized as an asset class under Reg 28. So that was, it sends a signal to retirement funds, that perhaps it was not an acceptable area of investment. There was a category of other where pension funds could do various things. And so pension funds who did want to invest into private markets, they used that other category, and that was only 2.5%. So, when the change came, which was only, not even a decade ago, then there was, it started to become more investment, and we saw, if you look at the slide that I showed earlier showing the growth of the private equity industry, there has been a lot of growth since that time, but off quite a low base. Yeah, so I think also it has been something that's been more difficult to invest in, and some of those sticking points that I was mentioning have been issues for retirement fund investors over time, and I think it's something that's been changing all the time, and something that's becoming easier for retirement funds to invest in. And now that the change in Reg 28 is well established, it's been a long time that pension funds have been able to invest. They've been more and more asking those questions and beginning their private markets journeys. Okay,
thanks for that. In your experience, I've got another question. What are some of the countries that are more business friendly from the point of view of such as taxation and such as obviously ease of doing business and obviously anti-free market terms for business and also good governance?
Well, I think so. What we're really discussing today is private markets investing locally, and using the global markets as a reference point to see what could be possible here. Look, I think the usual suspects of where it's easy to do business are pretty well known. South Africa has been a relatively more difficult place to do business in a lot of ways. If we're thinking about where private equity activity happens, a lot of private equity activity is happening within the US. It's the largest market. Europe is another very large area. But private equity is something that's been growing in every market, across emerging markets all over the place. You can see, and there's a lot of research you can see online about the growth of private markets investing across the world.
Okay. And then also maybe this particular question, with the increase in private equity, what is the failure rate between public markets and private markets companies?
Yeah, it's a good question. I haven't seen any particular stats around this. I think again, I guess the devil is in the detail. So the more earlier stage you go, the more failures you're likely to get. It comes down partly to what you would consider a failure, but if the earlier stage you go, the more risk there is attached to whether there's a sustainable business model that comes with that particular So as you go more into the venture capital side, you'll see that within a portfolio you would expect to have some failures within the venture capital end of things. But as you go up the scale and move in through mid-market investing up to the top end, you would expect much fewer failures to happen. In the listed side, obviously we've seen some very high-profile business failures. But I think those have been due to external other factors such as fraud. I mean, my personal view is that the ownership structure is not, it's not really the thing that's causing the success or failure. You can have successful listed companies and successful unlisted companies, and in a lot of ways, in most countries, they're subject to a lot of the same rules. All companies, whether they're listed or unlisted, are subject to, the Companies Act, subject to all the controls that happen around, through those regulations. And something that the private equity space really focuses on is governance. The most deals that happen, the first thing that gets done within companies is that the governance gets improved in private companies. So that means the establishment of proper boards of directors where they didn't exist before, the bringing in of independent directors, non-executive directors, establishing all the right committees, putting the right sort of controls in place within the companies. I think we've just in the last week in Germany we've seen the Wirecard fraud and failure. I don't think we can assume that listed markets prevent this sort of thing. And I think that the ownership model of private equity, which takes much larger stakes in companies and has a lot more to lose from a problem within the companies, is in a lot of ways provides a lot more comfort to investors that that governance is getting taken care of.
Okay, and then in just another question that has just come through. Do you think there's enough understanding of the opportunity to create real impact by investing in the real economy? And also, have trustees also been educated enough about the unlisted space in order to obviously drive that single digits that we currently saw in your presentation, obviously to increase it to at least double digits growth?
Yeah, so the impact side of things is such an important theme within the space. We're sitting in a country which has got a dire unemployment situation. There's a distinct lack of investment in the real economy. A lot of investment goes offshore, and this route. The private markets route is really important as a way to direct capital and everything that comes with the capital. It's not just the capital; it's the strategic input. It's the governance I was just talking about. It's all the measurement of the social and environmental outcomes that come with the investment from private markets investment. And so, you know, just to touch on it, I mean, the 274 itself, we've done a partnership with the Jobs Fund from National Treasury, because they saw that, you know, investing into private markets could actually create jobs, and as an incredible positive, and as a way to, they saw that the need for catalyzing more institutional capital into the real economy, as you say, was a way that we can actually help to create growth and create jobs and the kind of impact that we need in South Africa. On your question on trustees, I think you know, things are not easy for pension fund trustees. There's a lot for them to consider all the time. There's a lot of, you know, issues with members they've got to consider. They've got to consider the investment side of things, and for most trustees, the average trustee, you know, being a trustee is not their day job. They have something else that they do and that they focus the majority of their time on. So I think it's a big ask for trustees to be familiar with everything to do with the investment environment. But I think this is where the role of advisors come in, that they need to make sure that the trustees know what they need to know to make the decisions on behalf of their funds.
Okay. And then if those pension funds obviously had to double the allocation to the private market space overnight, would there be sufficient investable opportunities in order to obviously absorb this new capital?
Yeah, I think the opportunities wouldn't be the problem. There are thousands of opportunities out there. I think, look, a doubling overnight, everything takes a bit of time. So there would be a time period of implementation. But I think each of the, you know, there's more capacity. There's certainly more capacity in the system. So there's more capacity in the within private equity fund managers. They can take more capital, certainly. And there's if you look at kind of the wider market, you've got thousands of companies, and then you've also got things like, you know, the infrastructure program that's coming. You know, we've seen the ability of the REAP program for renewable energy to actually deploy large amounts of capital, and very well and responsibly in a way that's delivered good returns for investors. So there's, you know, the system, I think the system can handle it. And I think if there was a clear indication that there was more capital coming into the space, then we would see the private equity industry adjust and also create more capacity. So I don't think that's the limiting factor here. I think we've got a situation where our retirement funds saving pool is disproportionately large compared to the private equity space, and there's certainly more ability to take a greater slice of that.
Okay. A question that also has come through, what are some of the important aspects to look out for in fee agreements, and what are the worst fee agreements that you've currently seen within your tenure and experience within unlisted markets?
So look, I think with negotiating agreements with private equity funds in general, there's a lot to negotiate. It's they're not, while there is you know, there's a lot of negotiation agreements, but there's still a lot of points to be negotiated. And it's you know, I would say fees is not the only one. You know, fees is just one of many of the things to be considered. You know, you also want to consider that you're entering into a long-term partnership with the manager, because it's a long-term commitment. So you need to be thinking about all of the items that govern that relationship, and what would happen if, you know, the relationship turns sour. What would you do about it? What would happen if some key individuals that you rely on within the fund, if they were no longer with the fund, or they were, you know, not dedicating sufficient time to the fund? What would you do about it? If the fund is trying to make investments that are not quite what you wanted when you entered, or what you signed up for, what would you do about it? You need to think about kind of all of the things that can go wrong, and cater for those in your agreements. On the fee side, I think, you know, the way that we like to approach the fees is that we understand, you know, what the fees are used for. So we ask our managers for budgets, to show, you know, if they're asking for a particular level of fee, they should demonstrate why that's necessary. You know, based on the fund size, the base of capital that fees get charged on, convert it into rands and cents, and see, okay, where are those rands and cents going to go over time? Why do you need to spend this? If it makes sense, and you can get your head around the net returns that are going to be earned after that, and you think it's the right thing to do, and it's going to be beneficial to the portfolio as a whole, then you know, then you're in a good place. But you know, I think what we would have more of a problem with is say where, you know, there was a very large margin of fees earned on top of what the running costs of a particular fund are.
Okay, thank you very much for that, Rory. We have run out of time, but we will try get to all the questions and ask Rory to respond to the influx of questions that we have received that we were unable to take this morning. Rory, before we close off, please just say a few words to some of the participants.
I'm sure. Yeah. Thanks, Akona. Thanks everyone for joining. Great to have everyone on the call today. Like Akona says, we will have a look at all the questions and try to come back to you on those points. We will also be having more of these sessions, more of these 27.4 Academy sessions, and we look forward to as many of you as possible joining us next time. Thanks.
Thank you.